Hello, my name is Eddie Tofpik. I'm Head of Technical Analysis and Senior Markets Analyst at ADM Investor Services International Limited, and here is a daily technical analysis of foreign exchange markets. I'll start with the euro against the dollar. Okay, the headache may be starting to clear here. There are still two core patterns here currently in operation. I've highlighted the relevant trend lines in blue to help visualize what is going on. We have a possible September to date ascending triangle, currently 98.04 to 99.60, and a possible September to date bull channel, currently 98.04 to 101.45. The bull channel could actually be a rising wedge pattern instead, but that is not the real point here. The real issue is both patterns have had false breaks within the last 2 weeks. There was a false break above the upper trend line of the ascending triangle 2 weeks ago that turned into a pipe top, and a false break below the lower trend line for both late last week that turned back up last Friday and ended up closing on the upper trend line of the ascending triangle of all places. This was followed through higher this week, initially stalling at the very next resistance, the declining medium moving average, currently 10032. Now you can see why this market has been giving me a headache. Both patterns have been compromised, both repaired themselves and were now seemingly breaking again, but not forcefully, one of the patterns, and that's the ascending triangle, though we still sit here waiting and wondering which will dominate. It is at this point that I start wondering if both these patterns are correct at the same time. Schrodinger's cat for those who know the analogy. Yesterday's third bullish white soldier and second consecutive close over the upper trend line of the ascending triangle allows the opportunity to finesse some earlier targets for this pattern on the upside. Thus a primary target X would be in the 102.65 area, and a secondary target X1 would be in the 103.65 area. Looking at the bigger picture, part of me still hasn't been fully released from the idea that the lower time, currently at 97.85, of the big old broken January to May 2021 bearish Andrews pitchfork, as well as the middle time, currently 101.56, well, they may still be influencing the market. And so far today, a stable market over the declining medium moving average, but shying away from testing yesterday's high. Cable, aka sterling against the US dollar. A second market that's been giving me a headache. Much as in euro dollar, there are two core patterns here currently in operation. I've highlighted the relevant trend lines in blue to help visualize what is going on. We have a possible late September to date ascending triangle, currently 113.06 to 115.04, and also a possible September to date ascending wedge pattern, currently 113.06 to 117.39. The issue here, as in Eurodollar, is that both patterns have had false breaks within the last 2 weeks. A false break above the upper trend line of the ascending triangle 2 weeks ago, well, that failed at the upper trend line of the ascending wedge pattern and just short of the declining medium moving average, currently 116.65. Meanwhile, late last week, we had a contrary false break below the lower trend line for both patterns that turned back up last Friday and ended up closing right on the declining short medium moving average, currently 113.56. So both patterns have been compromised and both have repaired themselves, then breached again this week, though with yesterday only being the first proper close back over the flat upper trend line of the ascending triangle. Now you can see why I've had a headache here. I also, much like Eurodollar, started wondering if both these patterns are correct at the same time. That's Schrodinger's cat again, for those who know the analogy. Anyway, I've decided to keep for the moment, even though there has only been one single close over the ascending triangle this time, to keep the primary target X for this pattern in the 120.20 area, and the secondary target X1 in the 122.5 area. It now depends on what the market does when it meets the declining medium moving average. Now, so far today, a reactionary move back down through the flat upper trend line, below the October 2016 flash crash low at 114.5 and down towards the March 2020 low at 114.02. Euro sterling. An immediate countering bullish harami yesterday after the previous session's combined daily key reversal down and bearish engulfing pattern. Prices once again utilized the rising short medium moving average, currently 87.02, and the lesser Fibonacci line at 86.98 for a move up and close over the April 2021 high at 87.19. What was interesting about the move higher was how seemingly easily prices moved up through the recent congestion from early October, between about 87.69 to 87.80. Now looking below, we have the April 2020 low at 86.69 as potential support, and then the breach, but possibly repaired lower time, currently at 86.68 of the bullish April to August Andrews pitchfork. Meanwhile, overhead, there is a small congestion area originating from mid-September between 87.65 and 88.80 that has apparently capped the market in mid-October on a closing basis this week. Well, just keep your eye on a closing basis. So far today, a dip below the April 2021 high and then a recovery back up over it and pushing up through yesterday's high. Overhead, we have the 50% Fibonacci line of the March 20 to March 2022 move at 88.51. US dollar against Indian rupee. A fourth bearish black crow yesterday and an interesting test down and halt at the rising short medium moving average, currently 81.24. This moving average is not alone, as it has further support a little below from the recent 50% Fibonacci line at 81.13. Yesterday's action was a follow-on lower to the previous session's inverted hammer pattern. Now, inverted hammer patterns are interesting. You see, traditionally they're seen as a bullish reversal patterns. However, data indicates that something like 6 to 7 times out of 10 they act as bearish continuation patterns. In this case, the market followed the data rather than tradition. This brings me to a bigger pointer. I had previously highlighted how we had a September to early November ascending expanding wedge pattern. Late last week, prices had pushed down through the lower trend line, currently at 83.11, and the action since then has confirmed the pattern. Thus, we have primary target X in the 80.90 zone and a secondary harder to reach target X1 in the 80.28 zone. These might be all well and good, but as I said yesterday, and I quote, we start running into things, notably the rising short medium moving average and perhaps more importantly the recent 50% Fibonacci line at 81.13. So far today, an attempt lower, below the short medium moving average, but not by much, and certainly not enough to challenge the 50% Fibonacci line at 81.13. US dollar against the Brazilian real. An indecisive spinning top yesterday, but that doesn't do what happened any real justice. You see, we had a significant follow-on high yesterday to the previous session's immediate countering bullish engulfing pattern, punching up through all the moving averages, plus the 50% Fibonacci line of the May 20 to April 2022 move at 527.37, before failing, I suppose due to exhaustion more than anything else, and falling back down to leave yesterday as an indecisive spinning top, but with a really long tongue on top of it. We actually ended up closing right on the middle time, currently at 514.62 of the July to end of September bearish shift pitchfork. All this action this week is still putting a question on last week's weekly key reversal down. I am now casting one eye on the very slowly declining long moving average, currently at 509.73. That's below. US dollar against the Mexican peso. A bullish harami yesterday, and almost a bullish double as the market's highs and lows just about matched from the previous session. Prices halted for a second consecutive day at the late May low at 1940.70. The market continues to move lower, just under the upper time, currently 1967.73 of the broken March to July bearish Andrews pitchfork, and a little distance under the middle time, currently at 1977.69 of the still intact bearish shift pitchfork for the same move. Prices penetrated the 2021 low at 1953.63, but halted at the congestion just over it between 1955.65 to 1958 even. And that dates from early June. Thus, we still have the 2022 low at 1940.70 in the frame. There seems to be little below this support level until the March 2020 low at 1915.03. So far today, a small reactionary move back up over the 2021 low, but struggling to move up over the highs of this week. Well, was struggling, is now pushing through as we speak. Thank you for listening. This short version broadcast gives the essential market patterns and consequences. Please be aware of the risk disclaimer posted with this broadcast. Copyright ZD Tofpik and ADM Investor Services International Limited. And here comes the final bit.